Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in this video, we're going to be going through my top 5 tips for beginner investors in the stock market. I'm making this video, frankly, because these are all tips that I personally would love to have heard when I first got started. So I do hope they are useful, and I hope they save you from possibly some rookie errors up front in your investing journey. So with that said, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been my broker of choice for me, based here in New Zealand, to invest over in the US, and they have been my broker since March of 2019. I initially switched across to Hatch because of very low fees compared to what I was paying in the big banks. I can do trades in Hatch for $3 that were costing me $90 over the phone with some of the big banks. So it's been a massive money saver for me over that period of time. They also have a really useful blog series, which I've personally found quite helpful also, covering everything from taxation to IPOs to how to invest like the best that's ever done it, being Warren Buffett, of course. So if you're interested in getting started with Hatch, you will need to go to the link hatch.as/investingwithtom. If you deposit $100 into your new account using that link, you'll get a $20 top up, free money to get started investing with a little bit more cash. So my first tip for getting started with investing is to get started with investing, is to just go ahead and do it. The longer that you wait to get started with making investments and growing a portfolio, the worse off you are. Whether you're watching this and you're only 15 years old or whether you're watching this and you're 40 years old, the longer you wait, if you wait till you're 20 or till you're 45, if you wait an additional 5 more years, you're going to have 5 less years of compounding on your side. And compounding is really the powerful force that can help grow investments up into much more than the initial amount that you put into them. So I'm going to put up a couple of example charts here. Firstly, let's say you're 25 years old and you've got 40 years to invest before you hit the magical 65 years of age and you go into retirement. Now, if you invest $10,000 when you're 25 and invest it for 40 years, if you make around an 8% return, that's been sort of a typical long-term average in the stock market, that will grow your $10,000 into about $240,000 over that period of time. A substantial gain. Now let's take the example of someone who waits until they're 35 to get started investing. They put that same $10,000 to work. You will see they only end up with about $110,000 when they're 65. So the earlier you can get started and the earlier you can get compounding working on your side, the better you're going to be. And the other advantage of starting early is that you can get all the dumb mistakes out of the way with small amounts of money. If you start when you're 17 or 18 or 25 years old, somewhere in that ballpark, you're probably not going to have a lot of money to invest. You're probably not going to be working with 6 or 7 figures or anything like that. If you're investing a couple $1,000s and you make some dumb errors and lose some money, it's not going to be something that sets you back dramatically for the rest of your life. If you do, however, wait till you're 40 and you've got a couple $100,000 saved up and then need to figure out what to do with it, and it's really your first investing experience at that point, there's a whole lot more potential for things to go wrong that can impact you over the long term. So get started. It really helps with compounding and also helps you get any dumb mistakes out of the way with smaller amounts of money. My second tip is to invest and not trade. Now, shares fundamentally are a piece of ownership in a business, and that's how they should be treated. I think a lot of people can get sucked into the stock market through this idea of trying to make quick money and trying to predict short-term movements in the particular share price for a business. And really, we shouldn't be even paying any attention to short-term movements. The thing that is going to drive positive returns over the long term is the businesses you buy performing really well, or you picking up the prices of those businesses at some sort of abnormally cheap price. So perhaps they're going through some sort of short-term turmoil. You can get the shares much cheaper than you can usually. They recover and then the share price kind of bounces back up to reflect that. Or possibly, you bought Apple 5 or 10 years ago as they were ramping up their iPhone production and the market share that they had in that industry, and you've held that business as it's grown over a long period of time. Both of those two things are all about owning a business and buying it at a reasonable price, and those are the things that are going to drive long-term returns. Speculating and almost gambling in short-term price movements is not the way to go. Now, my third tip is to take your time and learn the process of investing. So I think a lot of people, even if they're getting started with maybe $1,000 or a couple of $1,000s, really have this idea in their head that they need to be super diversified. They need to, spread their money across a whole bunch of different baskets, and they need to do that from day one. That is not the case, in my personal opinion. So, you don't need to own 5 or 10 or 20 or 50 stocks after day one. Dipping your toe in the water with 1 or 2 or 3 companies can be a great way to get started and a great way to get some exposure to the stock market in general and start to understand how it works. And the other thing is, if we're treating stocks like businesses and trying to understand how businesses are performing, starting off with 1 or 2 small investments and a couple of companies that you really like can be a great way to make sure that you continue to follow those companies. So if you do go ahead and invest in a business like Apple or Microsoft or Tesla or whatever you want to do for your first investment, having a small number of businesses that you can keep on top of is going to be much better than trying to keep on top of 50 companies or just not trying to keep on top of them at all. Just putting your money into 50 different stocks and seeing what happens. I think you're much better off slowly building the portfolio up over a long period of time. Again, if you do make any dumb errors, you can get all those out of the way up front. And as your portfolio continues to grow and the businesses in there continues to expand, that's when you can start to put more and more money to work. Tip number 4, which flows on quite nicely from getting started with a small number of investments in tip number 3, is to invest in businesses that you interact with every day. So that may be the Apples of the world, it might be the Coca-Colas of the world, basically businesses that you are a customer of. This is going to be a fantastic way for you to keep tabs on whether you still appreciate the product range of that company. If you are an iPhone user and then over a long period of time you start to see that iPhones are starting to fall behind the competition or whatever it might be, that's going to be a really useful way for you to keep tabs on how the general customer base of that business is performing. I think a lot of people are trying to make fast money when they first get into the stock market, and they'll invest in some very speculative gold company or oil company or uranium miner or something that they just don't really understand, frankly. And I think you're a lot better off just starting with some sort of consumer facing brand that you're going to understand really well and have good handle on what that business does without having to actually do too much work up front. Now, if you happen to understand uranium miners really, really well, then more power to you. Go ahead and make that investment if you like. But basically, what I'm trying to get at here is that the easier the process to understand a couple of businesses, the more likely you're going to be able to make an informed investment in that company. So a great place to start is companies that you purchase the products from all the time and that you interact with every single day. Now, my 5th and final tip is something that long-term subscribers to this channel will know all about, and that is cloning the great investments. Now, there are many aspects of life, whether you're at university or school or work or whatever it is, where plagiarism will not be good for your financial health or your personal well-being or anything like that. Investing in the stock market is a massive exception to that rule. So there was a study that came out several years ago. I will put the title and link to that up on the screen here and maybe the link down in the description. Basically, they went through and looked at what would happen if you cloned, if you literally just copied the investments of someone like Warren Buffett, probably the greatest investor to have ever done it. What would your returns have been? And basically, they found that you would have beaten the market by more than 10% a year. You would have compounded money in the low to mid 20% range per year. And if you know anything about compounding, you will know that that rate of return will throw your net worth through the roof very, very quickly. So cloning the great investors is a really nice place to start to get investment ideas and track what people that you really respect in the stock market are doing. And the easiest way I find to do this is to go onto a site called Whale Wisdom. This isn't sponsored by Whale Wisdom or anything, it's just a site I like to use. Look up a few of your favorite investors and have a look at what they've been buying, what they've been selling, and try to get some ideas from that. So a great place to start would just be to go and look at Berkshire Hathaway, which is Warren Buffett's holding company. A few other 13Fs that I really like to look at would be people like Monish Prabhai, Guy Spear at the Aquamarine Fund, maybe Bill Ackman. There's lots of people out there, and the longer the period of time you spend in the stock market, the more people you, of course, will learn about. But that's a great place to start, is to clone the ideas of the best investors in the world. If there's a new investment in Warren Buffett's portfolio sitting in there, he's basically gone ahead and been your unpaid analyst and done all the work for you in order to arrive at an investment decision. So that's a really, really nice place to start if you're not super confident with picking stocks on your own. So there you have it. Those are my top 5 tips for getting started as a beginner in the stock market. I do hope you enjoyed. If you did, please hit like and hit subscribe. If you're interested in the Hatch offer, head to the link hatch.as/investingwithtom. Deposit $100 and get your free $20 for getting started with Hatch. So that is all from me today, and I will see you in the next one. Cheers.